COVID-19 has reshaped globalization and further strained Sino-American relations. How will this influence China's role in the Middle East and the wider Mediterranean region? The ChinaMed Tel Aviv University China in the Mid-Med series looks at this dynamic in conversation with leading global voices. Look at the world of tomorrow. Join the China in the Mid-Med series.
Good morning and welcome to the ChinaMed Tel Aviv University China and the Mid-Med series. It's a series of webinars that looks at how current global dynamic will impact China's future role in the Middle East and in the wider Mediterranean region. My name is Enrico Fardella. I'm a professor at Peking University and director of the Center for Mediterranean Area Studies and the ChinaMed project. Next to me, the co-host of this program are Professor Sela, the chair of the East Asian Studies Department at Tel Aviv University, and Friedman, the Director of Research at the Moshe Dayan Center at Tel Aviv University. And today we are also having with us Professor Giuseppe Gabusi from Torino University, expert of international political economy and also senior fellow at the ChinaMed project. I'm particularly honored today to welcome a friend, a colleague, and one of the most renowned scholars an expert of Chinese finance, Professor Michael Pettis. Good morning, Michael.
Good morning.
Michael is a real expert on China's economy. He's a professor of finance at Peking University, Guanghua School of Management, and non-resident senior fellow in the Carnegie Tsinghua Center for Global Policy. From 2002 to 2004, Michael also taught at Tsinghua University School of Economics and Management, and from 1992 to 2001 at Columbia University Graduate School of Business. Michael also worked on Wall Street in trading, capital markets, and corporate finance since 1987, when he joined the sovereign debt trading team at Manufacturers Hanover, now JP Morgan. Most recently, from 1996 to 2001, Michael worked at Bear Stearns, where he was managing director principal heading the Latin American capital markets and the liability management groups. In addition to trading and capital markets, Michael also has been involved in sovereign advisory work, including for the Mexican government on the privatization of its banking system, Republic of Macedonia, and South Korea Minister of Finance. Michael wrote several books, including The Great Rebalancing, Trade, Conflict, and the Perilous Role Ahead for the World Economy, published in 2013 by Princeton University Press, a great book indeed. And today, Michael is here with us to talk about his new book, just been published by Yale University Press. It's a book that Michael co-authored with Matthew Klein, the economics commentator at Barron's. And the book titled Trade Wars Are Class Wars. The volume traces the origin of today's trade wars to decisions made by politicians and business leaders in China, Europe, and the United States over the past 30 years. Decisions that serve the interest of the rich at the expenses of workers and ordinary retirees, and caused the present global economic distortions and the political rhetoric that derives from them. Thank you very much for being with us, Michael, and thank you for accepting our invitation today. So today we would like to begin our conversation by looking at the mechanic of the argument that you are sharing beautifully, I must say, in your book, co-authored with Michael Klein. So maybe you want to tell us a bit how your argument works, and then we can analyze it more deeply.
Sure. The basic argument, which we don't really invent, we're, if anything, reviving it, was made as far back as the end of the 19th century, most famously by the British economist John Hobson and his contemporary, the American economist Charles Arthur Conant. And the basic argument is that trade imbalances are not really conflicts between nations. They're the result of income distribution within individual countries. And that's why we argue that trade wars, the title is Trade Wars or Class Wars. It's a bit of a provocative title, but the point is that the real conflict that emerges from these trade conflicts is between economic sectors. So we argue, for example, that the reason you have a trade imbalance, the reason some countries are surplus countries and others are deficit countries, is not because, as popular opinion has it, surplus countries are hardworking, thrifty people, and deficit countries are sort of a lazy spendthrift people. It's got nothing to do with that at all. And I know for Italians, that's a particularly sensitive subject. You know, I was born and grew up in Spain, and it used to infuriate me because Spanish workers work more hours per year than German workers. And so the point that we want to make is not that this has nothing to do with cultural factors. This has to do with the distribution of income. The way you run a trade surplus is you pay wages that are low enough that ordinary households within your country cannot consume everything you produce. And this forces you to export your excess production to countries in which wages are still high. And it creates this dynamic in which we saw particularly in Europe at the beginning of this century, when in 2003, 2004, Germany, as you know, implemented a series of policies that reduced wage growth in favor of business profits. And as a result, German savings soared. Germany used to run a deficit before that. Since then, they're running the largest surplus in the world. And that's what caused the surplus. It had nothing to do with cultural factors. It had everything to do with the decision to lower wages relative to productivity growth.
Excellent. Very interesting. Giuseppe, you want to jump in?
Yes, Michael. I think, you know, the book really gives us a very, very, I would say, very comprehensive picture of, you know, all issues going on now in global political economy. And I think it's a right way to look really at the global scenario and putting together politics, economics, and also, you know, making it clear that it's more and more difficult nowadays to understand global political economy without understanding internal domestic politics and also policy choices. And as an IP scholar, I think this is really interesting because also in academia, you know, you have, you know, the traditional IR scholars, and then you have the economists, and it's very, very difficult sometimes, you know, to talk each other and to agree on a comprehensive picture. So I think this is why I really enjoyed. I've been enjoying reading the book, and I also wonder if you are thinking of an Italian translation, because I think that would be good also for Italians to be exposed to your argument, and you put together also, rightly so, the intellectual traditions. You know, there's a chapter on Hamilton and Hobson, Lenin, Ricardo, and also you make it clear how global value chains are really at the core of the argument in the end, because really it gives you the sense that, you know, for business people, the choices are made really on a global scale. You know, they have their own logic and the dynamics, and sometimes, because of course politicians, they have a domestic constituency, because in the end they have to respond to their constituencies. You know, they have to be accountable in some sense, even if they rule an authoritarian system. So in the end, there is a mismatch between the, you know, this domestic accountability and the global logic of the system. That's why in the end, you have this kind of, I wouldn't say conspiration, but in the end, there was like the elites in surplus countries and the financial elite in deficit countries like the US, basically, acting in a way that in the end increased the repression of labor and the compression of salaries. So decreasing wealth, income, and in the end, consumption of households. So that's why this combined with the austerity policies in Europe created this anti-elite sentiment, and in the end generated populism. So I think that this is a very, very rational way to look at the general picture. And I'm now wondering if in this kind of post-COVID or quasi-post-COVID-19 situation, you can see some changes, some coming to terms with these imbalances. And I can look at Europe, I can look at China, and maybe I can start with two questions together, one on Europe and the other one on China. And the first one is about the European Union. Of course, you advocate a kind of common fiscal policy in the European Union, because otherwise the Euro system cannot properly work in the right direction. So do you think that the latest Franco-German proposal of a recovery fund is a step in the right direction? I mean, why did Angela Merkel, in your opinion, change her mind? And maybe I'm just wondering if German elites, in the end, finally, they are aware, they've become aware of their shortcomings in pursuing the same kind of austerity policy, the same kind of ideology of basically that was behind the choices that Germany made. And how also could like deficit countries like Italy, for instance, convince the Netherlands or countries in the north to drop their opposition to the fund, and maybe explaining them rationally, explaining why they should also buy this story of rebalancing in a way the imbalances in Europe. And the second one is about China. Do you think that this new, very strong anti-China stance coming from the White House, and it's coming in general from the American elite, across parties and in the public opinion, do you think that this would give, in the end, an excuse to President Xi Jinping to tackle the vested interests that are preventing maybe China from shifting towards more redistributive policies, which could in the end raise household consumption and mainly addressing the imbalances in the end. So are we going to see some hopeful signs of a change in the right direction with this post-COVID-19 situation, or are you less optimistic than I am?
Well, I think one of the things we learn from looking at the historical precedents, and it's interesting how many historical precedents there are 1920s and 1930s being the most obvious, but previous periods too. And what we see is that imbalances always rebalance. This is just basic systems theory. imbalances will rebalance, but there are different ways that they can do so. In the case of China, when the trade wars started, and by the way, I think it's a real mistake to look at the trade conflict as if it's a Trump-Xi thing. The trade conflict was going to happen anyway, and the contraction in global trade as a share of global GDP actually began around 2011, 2012. And if you look at the graph without any dates, you can't really pick when Trump became president, because there's no change in the direction in the slope of the curve. It continues to contract. And I think this was inevitable. In my 2013 book, I argued that a contraction in global trade and a reversal of globalization was almost inevitable. And the reason I say that is because the problems that we have in places like in China and in Germany with the distribution of income are replicated in other countries, in the deficit countries, through the trade account and through the capital account. I want to step back a bit, if I may, and talk a little bit about why Washington's approach to the Chinese trade imbalances is based on a very obsolete 19th century understanding of trade. We're getting a lot of talk, for example, on the need to reshore American companies that had moved their operations to China. And one of the points that we make in the book is that offshoring isn't the problem. In a well-functioning trading environment, in the classic Ricardian environment, which, by the way, we don't live in at all, the way offshoring works is very straightforward. If an American company finds it more efficient to move its production to China and to sell back into the US, then it does so. And by moving into China, it increases...
Michael, forgive me if I interrupt you. Sorry, I really apologize. It was very interesting, but apparently, if when you're moving, I don't know if you guys it's the same for you, Brandon. You have the same problem with the video. Yeah. So the video stalled for in the last minutes and so.
I didn't have that problem.
Ori, you did?
So I had
so, okay. So sorry, Michael. This is good. I apologize, Brandon. I think that if you are then, since you are the recorder, the one who is recording, so you choose. Okay, I'm not going to interfere anymore. Okay, I apologize, Michael. It was very interesting. So let's let's start again from the trade being 19th century trade. I mean, trade conflict being a 19th century problem, or a 19th century approach. Okay.
Okay. What I want to do is to talk about this whole issue of offshoring, which I think is very illustrative of the way Washington's approach to the trade conflict is based on a pretty obsolete 19th century view of trade. In the classical trade framework, if we lived in the Ricardian world, which by the way we don't, but if we did, there wouldn't be a problem with an American manufacturing moving its production to China to take advantage of more efficient, cheaper labor or whatever. Because what would happen then is that the American manufacturer would move to China, it would hire Chinese inputs, including labor, it would pay for those, and then the increase in Chinese income would cause an increase in Chinese consumption and an increase in Chinese imports that directly or indirectly would benefit American manufacturers. So in a well-functioning world, offshoring isn't a problem, because what it does is it moves less efficient manufacturing outside of the US and brings and strengthens more efficient manufacturing by increasing their ability to export to China. That's how it's supposed to work. That's not how it actually works. And the reason is not the offshoring itself. The reason is that when you move the factory to China, Chinese workers are paid such a low wage relative to their productivity that they're simply unable to consume a substantial portion of what they produce. So in the US and Europe, if you produce 100 euros worth of goods and services, you typically get paid 70, 80 euros, whatever, and you're able to consume a big chunk of it. In China, you're paid 50. So as a result, your consumption is very low and your savings are very high. Now, any dollar that goes from China to the US must be recycled back to, that goes from the US to China must be recycled back to the US. That's how the balance of payments works. And the problem in China is that when they recycle that dollar back to the US, they don't do it in the form of imports. They do it in the form of asset purchases, right? And that's the problem with Germany and Italy, Germany and Spain. The money is not recycled in the form of imports, it's recycled in the form of asset purchases. German capital flows into Spain and into Italy and into other countries. Chinese capital flows into the US. Now, is this a good thing or a bad thing? Well, it depends. If you are a developing country in which investment is constrained by the lack of domestic savings, which is common among developing countries, in that case, receiving capital rather than exporting could be a good thing. This is what happened to the United States in the 19th century. It received tons of British and Dutch capital, and this allowed Americans to invest far more than they otherwise would have because the savings rate was too low to meet the full investment needs of the country. But in today's world, we don't face a savings constraint for advanced economies. You look at the US, interest rates are at the lowest in history. The market is flooded with liquidity. American companies, prior to COVID anyway, were sitting on huge hordes of cash and they didn't know what to do with it. So if you export additional savings to the US, it's not going to increase investment. They don't need more savings. What it does is it means that there is a net reduction in global consumption. And that's the problem. That's how this is replicated. So that's why we argue that the real problem is really a distribution problem. Now, you asked about Europe, and it just seems to me that Europe within itself replicates all the problems of a globalized world, but much more intensely, because countries within Europe have absolutely no defense against massive capital inflows from other European countries. Because you have a common currency and a common interest rate. So as a result, in the early part of the last decade, when German savings went from slightly less than German investment to massively above German investment, German savings soared after the Hartz reforms, which transferred income from workers to business profits. The classic supply side framework tells us, well, that's great, investment will go up, but investment won't go up. Investment actually went down in Germany as a share of GDP. And all of that excess savings was shipped into so-called peripheral Europe, massive amounts, among some of the biggest amounts we've seen in history. And how does a country react to that? If Spain or Italy were developing countries in which investment needs were extremely high, but there simply wasn't the capital available, then that would have been great. Those countries would have used that inflow of savings to invest productively and grow very rapidly. But as advanced economies, that wasn't the problem. Interest rates were actually negative in real terms in countries like Italy and Spain. And as a result, if investment doesn't go up, savings must go down. This is one of the, I think, hardest parts of our book to understand. Last week, I did a podcast with my favorite living historian, Adam Tooze, and he said that this was the part that really shocked him. The idea that a country like the United States or countries in peripheral Europe have no control over their current account was the real shocker. And I would argue that the reason is because we focus on the trade side of the imbalances, which is what we should have done in the 19th century, when the capital side was simply trade finance. Most capital flows were trade finance. But today, capital flows are independent. So if Germany increases its savings way above its investment rate, it must do something with those savings. And the easiest thing to do is to pour them into the rest of Europe. So countries like Spain ended up with massive capital account surpluses over which they had no control. And the necessary corollary of a capital account surplus is a current account deficit, right? They have to balance. So these countries had to run deficits, but not good deficits. That is a surge in investment, but rather bad deficits, a collapse in savings. It's got to be one or the other. And in the case of advanced economy, it's always a collapse in savings. And how do savings drop? Well, I won't bore you with all the details, but there are basically three ways. An increase in household debt, which we don't want, an increase in the fiscal deficit, which we don't want, or an increase in unemployment, which we want even less. And that's really the problem with trade. In a well-functioning world, moving manufacturing around isn't the problem. The problem is in the way the returns or the profitability or business revenues, or however you want to think about it, how they are distributed among various sectors within the economy. I'm sorry if that's a little bit long-winded.
No, it makes sense.
Thank you, Michael. Actually, I thought that was fascinating and helpful. I wanted to relate to the point you made in your comment regarding a net reduction of global consumption and related to a portion of the book in which you dealt with the BRI in chapter 4. And you mentioned that the real promise of the BRI for China is that it will create new demand for Chinese exports of manufactured goods and construction services throughout the regions in which the BRI is being rolled out. I'm first and foremost concerned with the Middle East, and I wanted to know how you thought the coronavirus would affect the potential for increased demand in the Middle East, perhaps even Africa and other places that have the potential for demand for Chinese exports.
Well, I think unfortunately the coronavirus hasn't really changed anything. What it's done is it's accelerated a bunch of existing problems. And in the case of China, the way BRI worked economically, politically it's a separate thing, but the way it worked economically is that if you have more savings than you have domestic investment, there's two ways you can deal with it, three ways. One is get rid of the savings by letting unemployment go up, which we don't want. Another way is to increase investment, but China is massively overinvested. And more investment is just non-productive. We all know that. Build more bridges we don't need, more railroads we don't need, et cetera, et cetera. So the only other thing you can do is to export it. And as you export those savings, the country that imports the saving must run the corresponding current account deficit. And we tend to focus on the bilateral deficit, but that doesn't really matter. One way or another, China must run a corresponding surplus against the capital that it exports. Now, most of the capital that it exports to the US, Europe, Japan, because it's much safer, but that's where the trade conflict arises. If it exports the capital to developing countries, that's a good thing, because developing countries have insufficient domestic savings to meet their investment needs. But the problem that China has been discovering, not this year, but 3 or 4 years ago, it started to discover it, is what every country discovers when they first go abroad and start investing heavily in developing countries. The US in the 1920s, the Soviets in the 1950s, Japan in the 1980s. And that is that it's very easy to lend money to developing countries or invest money in developing countries during the bubble period when things are going well. The problem, of course, is getting the money back. And I think China has had some very, very bad experiences, of which Venezuela may have been the most shocking to them. And as a result, I think that BRI, even before COVID-19, BRI investment abroad was contracting. I think there was this real concern that we're not getting the money back. And I think COVID-19 has made that much worse, because I think it's been terrible for developing countries.
Sorry.
So, two quick questions. First, in a sense, you outlined the problematic nature for a developed country when it gets more investments from outside of it, right? There's a problem with that. So here, the question is, what happens when we have this dynamic of Chinese investments growing within our region, the Mid-Med, what we call the Mid-Med, the Middle East Mediterranean, when it goes to those developed countries, and what kinds of economic relationships are built accordingly, and how that perhaps exacerbates other problems. I'll stick to that question first.
Well, I think that's a very important question, because the way countries resolve domestic demand deficiencies is to run current account surpluses. But all they do is they move that deficiency abroad. And so the recipient country only has a few options it can take. One thing it can do is to not allow foreign capital into the country, impose capital controls. Very few advanced countries do that. Some do it indirectly, but certainly the US, the UK, countries like that have no capital controls at all, which I think is a problem. The second thing you can do is absorb that incoming capital in the form of higher investment. And is there room for increased investment in the US from the private sector? Not really, because the private sector invests in order to serve consumption for the most part. And with consumption so weak, they're not going to do that. But there is a lot of room for infrastructure spending in the US and in Europe. And so one thing the US could do is say, look, we want to continue playing this role of absorbing excess savings in the rest of the world. But in order to do it in a way that's not harmful to our economy, we're going to significantly increase infrastructure spending. Now, this is such a politically difficult topic that I think that's very unlikely to happen. But at least it's theoretically possible. A third thing the recipient country can do is allow unemployment to go up. We import more from abroad, so therefore we'll stop producing at home and we'll fire the workers. Obviously, that's not a solution anyone wants. So that leaves really only one other solution, which is to increase consumption by encouraging households to take on more debt, which is what we saw in Spain and Italy and the United States and all of the deficit countries. And that's it. Those are the options. There are no others. So those are the kinds of things we need to be thinking about. Either allowing debt to continue rising, or forcing surplus countries to resolve their domestic demand deficiencies at home by imposing capital controls. I don't see any other option.
And a combination of the two is also a possibility.
Yeah, you know, the best thing, they say there's no free lunch in economics. It's not quite true. There are a few free lunches. And I think the most obvious free lunch is for the US to take all of this very cheap capital and rebuild its infrastructure, right? And I think Europe could do the same thing too. But I'm not going to try to judge the political likelihood of that happening, but that would be the best thing to do. If everybody wants to give you money for free, then use it productively if you have productive opportunities to invest it. But barring that, the options are either you allow domestic debt to rise, so you allow domestic unemployment to rise, or you don't allow the money to come in.
Thanks. If I can follow up, before we keep going on the Mid-Med, one quick question about China itself. Because when we're talking about China, obviously we're talking about many different Chinas in the sense of the huge differences between different provinces and so on and so forth. Do you see this kind of mechanism going on within China in the ways that the central government, for example, lends money to provinces, and the issues of loans and basically the domestic challenges that later on inspire the central government also to get some of the investments going outside of China? Well,
the problem with this, I think, is, first of all, China's growth model is not new. At least 24 countries since the Second World War have had these investment-driven growth miracles. And you could argue that it was probably developed first in the Soviet Union and in Germany in the 1930s. And you can even trace parts of it back to the so-called American system of the 1830s and 1840s. The way the development model works, and I call it the Gerschenkron model because basically Alexander Gerschenkron explained how this works. He argued that developing countries have two really big problems. One is the lack of savings for their domestic investment needs. They have high investment needs, low savings. So the solution, there are two solutions. One is to depend on foreign investment, but that's really risky. And the other is to boost the domestic investment rate, which you do by constraining consumption. And the easiest way to constrain consumption is to reduce the household share of GDP, because it's households that consume, not the rich, not businesses, and not governments. The other thing he argued was that developing countries have a very bad track record of investing in necessary long-term infrastructure. So his recommendation was centralize the investment process. And that's exactly what China did, like many other countries. And as in almost every other case, this was a wonderful idea. And the reason is because in the 1980s, after 5 decades of anti-Japanese war, civil war, and Maoism, China's investment was incredibly low, even for its level of development. It had nothing. It had 4 commercial airports, no modern bridges, no subway system, no manufacturing capacity, nothing. So forcing up the savings rate and piling it into investment, any type of investment, it doesn't matter how clever you are at picking investment, it's going to be productive and good for the economy. And so they did this. They had the highest investment rate, highest investment growth rate in history, and the highest investment share of GDP in history. Those are 2 different things. And the longest period of rapid investment growth in history. So this was very good in the beginning because China needed this much investment. It only had that much. And so the soaring investment brought it up to the point at which finally it was more or less correctly invested for its level of development. And here's where I think it's very important to read Albert Hirschman, because Hirschman argued, and I think he's completely right, that not all countries have the same ability to absorb investment. The difference between a rich country and a poor country is not that rich countries have more bridges. It's the other way around. Rich countries have more bridges because they're rich, and they're rich because they have the set of institutions, political, legal, financial, educational, cultural, whatever you like, the set of institutions that allow workers and businesses to operate more productively. So once you catch up to that point, then you do institutional reforms. But as Hirschman pointed out way back in the 1970s and 80s, nobody does that. They keep bringing investment up. Once they reach that, more or less that level to absorb it, they continue with the same very successful policy, and investment becomes too high, and that's when you start to see the rapid increase in debt. And it's you know, Hirschman died before the Chinese miracle, but he could have been describing it perfectly. And I think that's what we've seen in China. We're still addicted to supply-side reforms and investment to generate growth long after those were no longer the right policies, right development policies.
Giuseppe, you want to jump in?
In that sense, do you think that, you know, the RMB internationalization, which of course, you know, the state is pursuing, China is pursuing, do you think that would help a bit, you know, to revise this investment-driven, over-investment-driven kind of, you know, path, or not? I mean, are we going, you know, to see the dollar for several years to come as still the dominant reserve currency, or maybe are we going to see a possible alternative in the second part of the 21st century, for instance?
Well, I think in China, people who think having a dominant reserve currency is like having a very large flag, those are the ones who think that one day the renminbi will become a dominant currency. People in the PBOC, in the People's Bank of China, and people who understand the way reserve currencies work, I think they're much more skeptical. And I've been in China for 18 years, and we were always told within 5 years, China will be, the renminbi will be a major reserve currency. And it's not, it's 5th or 6th or 7th, and I think it's 7th now in trade. was fifth 2 or 3 years ago. It's not even moving up, it's moving backwards. And I would argue that the reason is because a reserve currency isn't like, you know, to me, a reserve currency is like having a large military. It may give you political strength. For example, the US can punish you by cutting you off from the banking system, but it doesn't give you economic strength. In fact, it's a huge economic cost. And the cost that comes from having the dominant currency is the cost of having your financial sector completely open to whatever it is that the rest of the world needs. Consider the last 100 years when the dollar was either one of the two dominant currencies in the 20s and 30s or the dominant currency thereafter. You'll notice that it comes in two neat 50-year phases. The first 50 years, the US was always a net exporter of savings. And the second 50 years, the US has always been a net importer of savings. It's always run a current account deficit. Now, is this a coincidence? I would argue no, not really, because the first 50 years, from say 1920 to 1970, the world was characterized by two incredibly destructive world wars. And why does that matter? It matters because all of the developed nations of Europe, Japan, etc., had their incomes destroyed by war and increased their investment needs. They had to basically rebuild. So they had insufficient savings for their domestic needs. What they really needed, the role for the US to play was as an exporter of savings. And the US ran huge current account surpluses during that period. It was an exporter of savings. By the late 60s, 1970s, Europe and Japan were substantially rebuilt. And as a result, their income levels and their savings went up and their investment needs came down. And what they now really needed was a place to park excess savings, or to put it in a different way, they needed a place to get additional demand. And you'll notice that the US, and frankly, all the financial systems similar to that of the US, the so-called Anglo-Saxon economies, England, Australia, Canada, the United States, they all went into deep and persistent deficits around that time. Australia and Canada from time to time emerge from deficit when commodity prices are high, but they're mostly deficit countries. England is always a deficit country. The US is always a deficit country, which, by the way, trade theory tells us is impossible. You can't run persistent deficits unless you are a developing country, and you can't run persisting surpluses. And yet the US has run 50, 60 years of large deficits. And I would argue that's what it takes to be the dominant reserve currency. If you want to be the dominant reserve currency, you don't need aircraft carriers. What you need is to be able to absorb huge amounts of excess savings from the rest of the world. But here's the problem. Chinese domestic demand is so low that they need to export excess savings. So who wants to be part of the Chinese currency system? It means you have to run permanent deficits in order to satisfy deficient domestic demand in China. People use the dollar, invest in the dollar, because that's where you can successfully invest your excess savings and run the corresponding current account surpluses. So could the renminbi become a major reserve currency? Yeah, it could, following a massive transformation of its domestic economy, which maybe will happen, maybe will not happen, but so far isn't happening.
Michael, can I ask a follow-up question?
Sure, please.
Along that lines. But by the way, there was a fascinating article by the American economic historian Yaakov Fagin on how the dollar system is actually a drag on U.S. interests, which is perfectly in line with what you were just saying. I wanted to ask a Middle East related question to the issue of the renminbi being internationalized. We see in the Middle East that 4 of the largest Chinese banks have moved into Dubai or the United Arab Emirates in 2018. I think the Emirates cleared something like $6.5 billion worth of yuan transactions. I'm not an economist, so it's hard for me to put those numbers in their proper perspective. I wanted you maybe to explain to me and others what China's interest is in terms of making the Emirates a center of Chinese banking. And I realize that oil is tremendously important to China, and obviously perhaps there's an advantage in conducting trade in oil in yuan rather than in other currencies. But is there any other interest in making the UAE a banking center for China?
Well, I think if I were China and I were concerned about potential geopolitical conflicts with the US, I would want to protect myself from dollar dominance in exactly the same way as I'd want to protect myself from American bases abroad. I'd want to undermine them. I think that what many people in China don't understand, those who are most eager for that, is that it's not just a question of calling someone up and saying, please, buy oil in renminbi. It doesn't, if you have an iPhone, you can buy oil in any currency you want, right? You've got a currency converter. No one's going to say that if you pay me euros for this barrel of oil, I'm not going to give it to you. I only accept dollars. No, you can convert euros into dollars at no cost. The denomination of the trade really doesn't matter. What really matters is the willingness to accept all of this inflow in savings. And so China's making all of these attempts to create an alternative banking system which isn't really dependent on the dollar and therefore cannot be controlled by Washington. But I would argue that, if you look at the evidence so far, there's really no evidence that it's working. People say the amount of transactions in renminbi is going up. Not really. It goes up sometimes and it goes down sometimes. But take a look at Mexico. The Mexican peso is a far more important currency relative to the size of the Mexican economy than the Chinese renminbi, right? It's the second largest economy in the world. It's got the seventh most actively traded currency. It's got a long ways to go. And I would argue it's not because of want of trying, it's because of a misunderstanding of the costs of a renminbi world and unwillingness to accept those costs.
Thank you.
Michael, if I may jump in, going back to the Trump administration and the China, policy of the Trump administration, what do you see like new steps being developed in the next month by the Trump administration in financial terms vis-a-vis China? For example, you mentioned capital control.
Capital controls, I don't think are going to happen because I think Trump's main advisor on trade, Peter Navarro, really, I hate to say this, but I think he really does not understand trade, not in the 21st century, he doesn't understand it in the 20th century. But that doesn't mean that other people don't understand it. Two American senators, one a Democrat and one a Republican, submitted a bill on July 31st of last year, tasking the Fed with imposing a tariff on all capital inflows into the US and raising the tariff so that over a 5-year period there would be balance. Now, I was really surprised to see this because I think it's a good idea, but I thought it was going to take 15 years to get people to see the point, and it's happened very quickly. So I would argue that maybe not in the next year or two, but in the next 5 to 7 years, we may see a significant shift on opinion over this whole issue of unfettered capital flows. So that even rich countries like the US, Europe, Japan, will end up deciding that free capital flows don't really bring any economic advantages. By the way, you'll remember in the Bretton Woods, which was basically a conflict between Harry Dexter White's proposals and John Maynard Keynes' proposals, one thing they both agreed was that while free trade is a pretty good idea, neither of them were obsessed with totally free trade, but basically free trade was a good idea. They both agreed that there was no economic justification for free capital flows. So I think we're moving in that direction, and Matt Klein and I hope that our book is one more step in that direction.
Thank you.
If I can just add, your question was about about things that Trump might do. I think there's a lot of things he might do. And I say this with some trepidation. You know, we are in an election year. I think it's going to be a very difficult election for him. And I think he's erratic enough that there are a number of things he could try. I just don't think that they're going to matter much to the real underlying problems. So, for example, if you believe that the reason China runs a trade surplus with the US is because China can produce things more cheaply and more efficiently, then imposing a tariff on Chinese imports would reduce the American deficit with China, and the overall American deficit with the world would come down too, right? That's 19th century trade. If you believe that the reason the US runs a deficit and China a surplus is because of capital flows, then imposing tariffs on Chinese goods should, in theory, reduce the American bilateral deficit with China and increase the American deficit with the rest of the world. It should reduce the Chinese bilateral surplus with the US and increase the Chinese surplus with the rest of the world. And guess what? That's exactly what happened. The American deficit didn't come down. The American deficit with China came down, but the American deficit with the rest of the world actually went up by even more. And that's what you would expect in a world in which imbalances are driven by capital flows. So they'll continue talking about tariffs and about subsidized purchases, et cetera, et cetera. And ultimately, they'll be able to declare victory because the deficit with China will go down, but it'll not affect the overall American deficit. It'll have no impact.
So, one second, Ori, I just want to add something. Then there is Brandon. Then you can close if you like. So, Michael, let's say that then this kind of approach to trade probably has a return in terms of electoral politics, right, for November. And then people slowly are going to understand and appreciate the logic that you just mentioned about, capital, and capital control. So in a scenario in which, for example, in 1 year from now, in the US, there is a sort of consensus on applying capital controls from capitals coming from China. Which kind of effect do you think this might have on China? So how China is going to use all this amount of capital that cannot, be channeled to the most, to the safest and most, profitable, destination?
I think it's window dressing, cosmetics. It looks good. We won't let China have our money. The problem China has is not that it has insufficient capital to invest in all of its in potential projects. The problem China has is it has way too much capital. Capital in China is almost free here. So it really doesn't matter. The only advantage of American money going to China is if it brings technology with it or managerial skills with it. But that's not the type of capital they're talking about. They're talking about portfolio flows, which really don't matter. China wants portfolio inflows because in the country that pegs its currency, its domestic monetary supply is constrained by the growth in reserves. So they want reserves to grow. But the impact of U.S. strictures on capital flows are going to be really, really minimal. Unfortunately, it's the opposite of speak softly and carry a big stick. It's speak loudly and don't carry a stick at all. It doesn't really matter.
Brandon.
Michael, you mentioned Adam Tooze a few minutes ago. I often enjoy reading him as well. He's written a lot recently about the importance of swap lines in trying to restart the economies, particularly those in the developing world. And there's been this debate about US swap lines versus IMF SDRs. And I wanted to know what China's view was on the IMF or the role of swap lines in any sort of global recovery. Do they have a horse in this race? Does China have a particular view on a direction the IMF should take? Or is China sort of standing aside and letting the US sort of sort this out? I guess that's my question. And it's a question that has a huge impact for the Middle East because there are several Middle East economies on the verge of collapse right now. And so this issue is not a theoretical one here. We could see the region go up in flames in the next decade if there's not some kind of assistance.
Right. Well, one of the problems with the system that Matt and I are describing, and we're not unique here, I think most people would agree with us, is that the Fed is no longer the central bank of the United States. It's the central bank of the global financial system. And during a crisis, the system moves even more towards dollars than normal. So the question that we have is it good for the U.S. that its central bank is not focused primarily on U.S. needs, but on global liquidity? And I would argue it probably isn't. There should be a way of segmenting the domestic financial markets, which was the case up until the late 1970s or early 1980s. There were capital controls. There was an offshore dollar market and an onshore dollar market. Maybe we need to go back to that. But from the point of view of swap lines for countries in the Middle East, I'm afraid that isn't really going to happen because the Fed is expanding liquidity, but it can't take credit risk. So it's expanding liquidity to countries like England, Europe, Japan, etc., countries with whom it believes it doesn't have credit risk. Some people have argued what the Fed should do is expand liquidity to the IMF and allow the IMF to lend money to developing countries. But that's simply taking credit risk in a different way, because now it's the IMF taking the credit risk, and they become a major creditor of the Fed. And if developing countries are unable to pay them back, then the Fed has a real credit problem. And while some people will say, well, fair enough, developing countries need the money, they certainly do. And we certainly should be putting together facilities that create credit and that eliminate the liquidity risk for some of the developing countries. But let's be very clear, that is a risky proposition which should be done for reasons that have nothing to do with monetary policy. It's not the role of the Fed to make lending decisions to developing countries. And I think if it did, I think that would be a much, much bigger problem, because now we have the Fed as the major central bank and development institution of the world, and I don't think it's well placed to play that role.
Is that, does China feel that this is an issue that it will need to weigh in on at some point, given the existence of the BRI and its stake in the BRI, and the nature of the fact that the current crisis affects much of the developing world, and that is supposedly one of the big, I suppose, marketing headlines of the BRI?
Yes, it's sort of a puzzle, but if you take an historical point of view, maybe it's not a puzzle. But one of the big advantages of having taught at one or the other of the two leading schools in China for 18 years, and I'm very close to many of my students, as Enrico knows, and some of them are now quite senior, and one of them is, for obvious reason, I can't give too much details, but he's quite senior in the entities responsible for lending to developing countries. And when the whole problem emerged in Venezuela 3 years ago, I remember going to him. Everybody was waiting for the IMF to come up with a restructuring of Venezuelan debt. And I remember going to him and saying, you know, half of the debt is Chinese debt. Why are you waiting for the IMF? Why don't you guys put together an intelligent, smart proposal to the Venezuelans for a real debt restructuring, and then bring everybody else in? It'll make you guys look great. And I remember he was terribly excited by the idea. And I even said, look, I'll help you. I have plenty of debt restructuring experience. I'll help you for free. And then he came back and said, no, it's politically too difficult. Nobody wants to be the one to recognize that we're not getting back 100 cents on the dollar. And I've seen this before. Official lending gets really caught up in the politics of window dressing. And until that changes, I think it's very hard for China to take the lead in this in the restructuring of developing country debt, because the fact is you're not going to get 100 cents on the dollar. You know, sorry, you're not, and you have to recognize that. And if you can't recognize that, you get these half-assed restructurings that, every 2 years you have to go through the whole process again. And unfortunately, I think that's what's going to happen in the next several years. A bunch of very painful, theoretically unnecessary, but politically necessary restructurings that will keep growth, will keep developing countries from growing for many years. One thing we do know, and we saw this very clearly in the 1980s, is that during the permanent restructuring every few years of debt, economies simply don't grow because the uncertainty surrounding the restructuring is too great. Nobody invests. And unfortunately, I think we're stuck with that.
That was very helpful. Thank you.
Ori, you want to close?
Sure. I think that, and correct me if I'm wrong, but much of our discussion so far has assumed a great deal of interconnectedness in the global economy. And one of the things that we've been hearing in the, let's say, at least a year and a half, is the discourse of decoupling, which comes mainly from from issues relating to technology, but you can't separate, technology, economy, and so on and so forth. So my question to you is, do you see this kind of discourse of decoupling affecting the economy or even happening? Is decoupling perhaps even something feasible economically in the type of world that we live in or that we can imagine for the next few years?
Decoupling is going to be very painful, but not decoupling will be worse, in my opinion. I think we have to go through that. And the reason I say that is because in our sort of hyper-globalized system, and again, this is the real topic of the book, policies that repress wages in one country force other countries to repress wages. When businesses say, we would love to raise wages, but we can't. If we do, we lose competitiveness and we have to move everything abroad, and so we get no benefit from it. I mean, that's a self-interested argument, but it's also literally true. The way you gain competitiveness in today's world is you force down wages, either directly, like the Germans did it, they forced down the growth in wages, or indirectly by subsidies, by taxes, by depreciating your currency. There's a lot of ways of doing it. Destroying the environment is a way you effectively lower wages because the costs for households go up and their wages don't. There are many ways you can do it. But the point is that you have to do it if you want to remain competitiveness. Competitiveness is the great boogeyman of a globalized system. And as a result is when some countries take steps to reduce wages to gain growth at the expense of the countries, then other countries must follow suit. And as a result, you can never raise wages. I saw that was my connection okay? I saw a sign.
It's been a little bit going in and out the last 30 seconds, but I can still hear you despite that.
Okay.
Yes,
so if you believe like I do that income inequality is the most serious global economic problem, because income inequality is good when you are a developing country and you need high savings. It's bad in a world of excess savings. And we need to reverse income inequality. But how do we do it? If you raise wages, you take all of the costs of raising wages, but the benefits of raising wages bleed abroad because you lose relative competitiveness. So I think, I'm a big buyer of Danny Roderick's argument about globalization. In a globalized world, you have to give up control of your domestic policy. And I think the election of Trump, Brexit, Turkey, Hungary, everything we're seeing in the world, Brazil, China, you get the sense that people have had enough. We need to regain control of domestic policy. So I think decoupling is going to be very painful, but it's going to be inevitable. We have to decouple to a certain extent and then sort of rethink our global system.
Very interesting. Thank you very much, Michael, and thank you all for this wonderful and stimulating conversation. Michael, I really hope that your new volume will get the success that it deserves. Thank you so much for letting us reading it enjoying this wonderful conversation with you. And I guess we all meet in Beijing soon, hopefully.
I hope so.
Thank you so much. Thank you so much, Michael. Thank you,
you.
Ori, Brandon, and Giuseppe. Thank you very much.
Bye-bye.